Let's talk about bonds and the Federal Reserve first. And this economic backdrop, this is a big change for you. I remember being with you 12 months, anticipating that, 12 months ago, anticipating that hard landing. Not anymore. Why do you think this can continue?
Well, 12 months ago, there was every reason to expect recession. There were rate shocks delivered. Everything looked frail. I would argue in March we had that recession with the collapse of the regional banking system, but the policy response was overwhelming at the time, and within a couple quarters we realized it was more like a TARP moment than anything else. So things are stabilized and we took off again. And I think as the year has gone by, businesses and households have managed to absorb the higher level of prices. Yes, they don't like the higher levels of prices, but we're in a disinflationary environment, not an inflationary one, and unfortunately not deflation just yet. So it looks good. I'm tempted to see how much of a high five Jay Powell wants to give himself in the Fed next week.
You think there might be a victory lap?
They're entitled to it. When you look at it, it cannot possibly get better than this. You've had 25 consecutive months of unemployment at 4% or lower, and I guess we'll get another update in about 45 minutes or so. But when you look at the last 6 months of core personal consumption expenditures and annualize that, 1.9%, that's their 2% target. They are there.
I'm not expecting Chairman Powell to walk into the room and start high-fiving Mike McKee anytime soon. I don't think that's ever happening. But Bob Michele, what do you expect he will do next week? Is he going to tee up rate cuts in March, given what you've just said?
I don't think in March. I think June is where the market has gravitated to, and I think that's a good marker for him to put out there. I like what Christine Lagarde did, which is to acknowledge that there has been improvement, that they can think about things, that the level of rates is substantially pulling inflation down, and there's an opportunity to make a shift. When you look at the real Fed funds rate, the Fed funds rate's 5.25% to 5.5%, and if you're around your 2% target, the real Fed funds rate is 3.25%, 3.5%. That's way above what the Fed is telling us is normal.